Welcome to The Truth About Ag.
Welcome to the Truth About Ag podcast, distributed under the Real Ag Media Network and powered by the Heber Group of Companies. Remember to like, share, comment, and subscribe wherever you get your podcasts. Now, I would say that the guest today that we have probably doesn't need any introduction because I see him more on Twitter than I almost see my business partner, which is probably a good thing. But JP Gervais, Executive Vice President, Strategy and Impact, and Chief Economist. What does that actually mean, JP?
Well, this is perhaps the hardest question I'm going to face today. So first off, thanks for the invite. It's great to be sitting down with both of you. Really, I've been with FCC 15 years, and I started off as an economist doing economics things, and slowly kind of got my role extended to different things within the business, right? So right now, what it looks like is if we're pretty excited about the strategy that we put forward at FCC. We really think we can have impact in 6 areas, and I could go on and talk about this strategy, but it's really about making sure that we're planning and executing the strategy to reach and have a maximum impact in terms of innovation, exports, economic growth. We do a lot of good things in this country when it comes to ag and food, and we think that, by being a catalyst, not doing it ourselves at FCC, but really bring everybody together and working with partnership, we can actually maximize and optimize that impact quite a bit. And so that's really the role. At the end of the day, I still wear the hat of Chief Economist at FCC, but really more in terms of moving the strategy forward, bringing in the partners, and really looking at execution. And you would know this within your business as well, right? You can have the best plan, but at the end of the day, a lot of the competitive edge is with regards to execution. So the better we execute, I think the entire industry is going to be better off. That's the role in a nutshell, really.
And has that changed a lot? I mean, obviously, when Justine came on, things kind of got shook up a little bit. So is that really different from what you guys had before, JP?
It's I would say yes and no, right? So I think what is not different is the core of FCC has not changed at all, right? It's all about making sure that we advance the business of agriculture. But what has changed is the emphasis, how we want to go about it, realizing that we're not going to do it by ourselves. So first off, we got to make sure that we bring in the right partners, making sure that we build the capabilities, whether it's from a farm management standpoint. We've done a lot of good things in the past, but really there are plenty of other things that we can do to actually lift up, the farm management skills of the customers we serve and the industry in general. So it's all about building those capabilities, bringing a lot of innovation in the country, and we'll have a chance to talk about it for sure. But the one thing that I really feel about is that we can really step up our game in terms of bringing in more investments at upstream and downstream, really, right? Because we've focused a lot over the years about what is going on the farm, but actually as well building the different capabilities around the farm, really upstream in terms of inputs as well as downstream in terms of value add and so forth, actually makes the farm sector stronger. And I think that's what has changed at FCC is to have the supply chain emphasis as well, not forgetting about that. At the end of the day, we're here to advance the business of ag. So that's what it is.
I'll let you start, Kristjan. Obviously, we got 3 finance guys on here, so this this has a lot of weight.
Is he finance heavy?
Yeah.
You two are more finance than me. I just not know enough about to be dangerous. Yeah, I mean, I think we'll start with the execution part first because I mean, it's pretty close to our hearts. We call it Jeff, right? Jeff's my COO, and some people ask, why I hired him in the day, but it was all about execution. So, walk me through big banks, which is part of your guys' role, aren't always known to move very fast and execute at high speed. So walk us through, some key priorities for not only 2025, but say, you probably did about a 10-year outlook. What are some of the key stuff for 25 and beyond that you guys want to execute on that you think will have the biggest impact in the industry?
That's a great question, right? To your point, I mean, it's a business. I mean, our loan portfolio at FCC is over $50 billion now. It's a big ship to steer, right? So when we are trying to steer the ship in a slightly different direction, it's not that easy, right? And most, I would argue, and I feel like, so I'm glad you asked the question. First off, I think that there are a lot of different similarities between a financial institution and how farmers can actually lead their business, right? So when you come in terms of like strategic plan, right? Do you have a strategic plan, right? You have to have those objectives, whether they're 3 years, 5 years, we do 5 years, but because we're required to do so, but you could probably keep it at a 3-year type of time frame in terms of like, where do you want to take your business? What are the things you want to accomplish? And what are the key performance indicators, right? And so, for example, at FCC, we would set KPIs. These would be our public commitments, right? Those are the things that we are actually going to achieve this year. And then we also are kind of just thinking about building what we call OKRs, organizational key results. And those are things like that we want to stretch, right? Think of like moonshot type of thing. Like, and if we get to 70% success for us, that's going to be good, because we know that we stretch quite a bit in terms of making it this ambitious. Because if you don't make it ambitious enough, you know, you're going to have a really hard time actually investing as well. So bottom line is, you know, when you think of, you know, what are we working on right now, we're really looking forward to build more resilience in the supply chain. And I think it's topical with regards to the tariffs we face. We might have a chance to talk about that as a little bit as well. You think of the capabilities, you know, when we are talking about software, we think we can offer some software solutions, not just, you know, with the current Ag Expert platform, but really just bring in different, you know, things within the platform itself to be able to actually help on the management side of things. You know, we're always looking at products, because at the end of the day, we offer financial products, you know, different types of loans and so forth. So those are the things that, you know, we're reviewing also and try to build and offer and come to market with a slightly different offering that can actually appeal to different types of businesses. And I would say one of the things that I would name as well is the ability for us now to offer different capital solutions, right? Over the years, FCC has been recognized as a term lender. And now we have the ability to invest in equity, offer different types of financial solutions and capital solutions to different businesses, with the idea to build a really strong ecosystem, right? So just to have this entire supply chain perspective, bring in new technology so that, and then also de-risk the adoption of technologies from the farmer standpoint so that, you know, we can actually lift productivity for the entire supply chain. So those are the things that we're working on right now. A bunch of other things as well. And I'm sure that some of my colleagues are listening to this and saying, oh, we forgot about this. Well, yeah, I did. Just there. That's what it is.
Well, and that's what I find that I like a lot about, like, most of my conversations, to be fair, JP, with you guys, is more around the education components and the investment components that you guys have on the venture capital side. And it's not just a bank, which is always kind of been, you've kind of been grouped in with all the nationals. And to tell you the truth, the amount of investment you give back into the industry is 10 to 1 what we're seeing from some of the others. So
yeah, and I think one of the things is, let's face it as well, we have a very strong balance sheet, right? So it's really trying to put our balance sheet to work for the industry. Because I mean, that's all we do, right? We're not going to go away. You know, tariffs are going to be coming in, and we're going to be right there because we have a history of offering customer support, right? So whenever there's a drought in a part of the country, or whatever we're faced with logistical challenges because of port strikes, and whatever the story is, we have this history of supporting customers. And so I think for us, it's really to be able to leverage the balance sheet that we have and offer solutions that are going to make an impact, right? I think that's really the critical aspect of the strategy.
well, I think part of it, we want a little bit today for the farm. So I'm going to ask you about the current state of agriculture, kind of from your opinion and where you see. And then we're probably going to, I know January 23rd, you guys did your outlook, so I wouldn't mind picking your brain a bit on it too. But let's start with today. Where do you see the ag industry today from a primary production standpoint?
Primary producers, I am always optimistic. But let's face it, the uncertainty right now that we have in the marketplace, I've been doing this for FCC 15 years. Prior to that, I was in academia, and I don't recall having to deal with the level of uncertainty that we have right now. This trade relationship that we've had for so many years with the US has been, by and large, a huge success. We've had the little bumps here and there, and then, you know, you can, you know, on supply management, on countervailing duties in the hog sector, on some inspection and sanitary measures and so forth. But the bottom line, you know, and even beyond ag, the bottom line is that it's been a hugely successful for both countries. And now we have somebody that is trying to disrupt this a little bit, quite a bit actually. And to me, that's where, you know, it's hard not to think of this, when you think of the outlook, because if you go beyond that, the demand for what we sell worldwide still very strong. I mean, we have productivity issues, but the glass is half empty, half full. I mean, if you compare the ag sector with the overall economy, I think we're doing better in the ag sector than the overall economy, but it doesn't mean that we don't have anything to fix on our end. So we'll probably, gotta roll up our sleeves and start to do a few things about this. But the bottom line is and then we produce one of the most sustainable food in the world, really, at the end of the day. I mean, we've got lots to celebrate. It's just this entire big dark cloud now that just on top of everything that kind of just darkens the outlook a little bit, because let's face it, if we do have tariffs, whether at 25% or whether they're slowly ramped up to whatever the end number looks like, it's going to be quite disruptive, right? Everything that we've learned over the years about marketing in terms of relationship, balance between demand and supply, all of that is going to be disrupted in some ways. And then we're going to have to just, react and then, ramp up in terms of, our risk management from a financial standpoint, a production standpoint, marketing standpoint. So it can be could be quite disruptive, I would say.
It's pretty easy to agree on it, right? Our last kind of farmer coach session, we did an internal survey. And I mean, I've been beating the drum that my biggest risk is policy, just because I can't control it. And it's really tough to manage for, right? And specifically in agriculture, because we're so tied to global trade. And so it's not just disruptions in Canada. And on our last survey, I mean, it was tied commodity price volatility, policy risk, policy and regulation, because a few guys, PMRA was really starting to bug a few guys. And third, just geopolitical risk. We're all exactly tied for the biggest risk to production agriculture. And in the past, it's always been wed by their commodity prices.
Yep.
Right. So I think it's really brought it to the forefront, and now it's interesting. What are we going to do about it? So obviously we got a guy that likes to negotiate on the other side and sees a huge opportunity, because let's be honest, we've opened the door to unrest. We have a lack of leadership in Canada right now. So it's the perfect group to negotiate a little bit crazily with, and he likes the crazy side.
About a year ago, I was pointing out that one of the things that we needed to worry about or think about for sure was that relationship between the U.S. and China. That if, the first administration came hard on China for a little bit there, and then it led to an agreement between China and the U.S. But for a while there, the U.S. was taxing exports of China. China retaliated on soybeans, for example. That kind of disrupted pricing. And then it was not a big deal for the U.S. farmer, because basically they're taking the tariff revenues and then compensated U.S. producers with the amount of the tariff revenues that we're collecting from China. But it did for us disrupt the pricing mechanism in one very specific commodity. But now, 12 months later, I think we're staring at an entirely set of different things, right? I always point out the three things, right? So one of which is like the narrative, for example, right now is U.S. tariffs will raise the price of U.S. buyers. All right. But that's not the end of the story, because if it would be the end of the story, then it's all U.S. costs and nothing for us to worry about. But then if the price of the buyer in the U.S., take the Canadian price, add in the 25% on it, that raises the price of the buyer is sensitive to price, right? So buyers going to look towards, other opportunities to buy stuff. Might not be that they actually right away kind of give up on Canadian commodities. But the fact of the matter is they're not going to stand still and say, all right, I'm happy with another 25% on what you guys sell. And so they're going to look elsewhere, and we might see a little bit of disruption on trade flows. But I think the most disruptive thing can be the third thing, and that's really just the impact on pricing on our side of the border. Because those buyers in the U.S. say, hey, I can do this, I can source that at that whatever price. And so what are you willing to do in terms of an adjustment to your own price, because that reference price that we have in the U.S. market no longer is what we want to really monitor, because there's that 25% tariff there at the border that kind of brings a differential between the U.S. and Canadian price. So there's a potential for Canadian prices to go lower the more you're exposed to the U.S. market, and so forth. I mean, there are sets of conditions that you can think about that will have an impact, and it's hard for me to say what will be the impact overall. But the bottom line is I do anticipate that we'll be faced with lower prices, and that is something that can be quite disruptive, right? And it clouds the outlook that I feel is overall fairly positive. I'm super optimistic. Just this this thing is introducing a lot of uncertainty, and then businesses don't like uncertainty, like transparency, predictability, obviously, you know, when you make investments and so forth. So bottom line, I think it can set us back if we're not able to navigate this.
So what do we see that doing to interest rates and our own internal policy at Canada, and obviously big things that are going to affect our consolidation, affect growth, affect land prices?
I mean, so when it comes to interest rates, we got a Bank of Canada decision pretty soon. I do expect that the bank is going to cut its interest rate again. The economy in Canada is slowing down so much that I don't think they have much choice. In our outlook, we projected by the end of 2025 will be another 75 basis point lower when it comes to the Bank of Canada rate. But I would argue that I'm not going to say that's irrelevant, but interest rates have already kind of moved to their own trough, right? So, I mean, we've seen fixed rates go up. We have an interesting chart in our group that basically looks at the pattern in the, let's say, long-term money, cost of long-term money, 5-year rate since the U.S. Federal Reserve cut. So forget about the Bank of Canada, really since the Federal Reserve started to cut its own interest rate, and now they're probably going to be on pause. I get it. But actually our interest rates went up, just like in the U.S. So we're basically seeing, a cost of money long-term move up. So Bank of Canada is going to keep, cutting its interest rate for a little while there. That's going to bring a little bit of relief for your credit lines and so forth. But if you're looking to make an investment long-term on a farm, probably looking at, where 5-year rates are right now, it's probably going to be perhaps the cheapest that they'll be all year. And there might be a little bit of upside to that interest rate even in the future, depending on what the U.S. does again with with tariffs and so forth.
I want to take this moment to give you a little highlight on one of our sponsors, Maverick Ag Consulting, providing the link between primary producer agriculture and the business world. Maverick offers specialized financial and operational consulting products that allow farmers to navigate the current farming environments. Looking to take on more dirt, an expansion in equipment, or just lay down a strategic plan for the farm? Maverick provides you with specialized resources and tools to take the gut check and emotion out of decision making. If you are ready to take the next step in your farm's definition of success, reach out to maverickag.com for more details. And back to the truth about ag. Because it hasn't happened a lot where the long-term rates were actually lower than the short-term rates, right? Like this is an anomaly.
And then we're beyond that. This is now we're looking at a fairly straight upward kind of yield curve. And usually when you're staring at this, it's because the prospects of your economy are really great. Financial markets are saying, oh, we're going to grow. The economy is going to grow. So interest rates will have to come up at some point. But right now it's more like the economy is not doing really well. On a per capita basis in our economy, we've been seeing, 6 consecutive quarters of decline in GDP on a per capita basis, like 8 of the last 9 quarters. I think we recorded a decline. It's basically the only reason we have long-term rates higher than short-term rates is because of what is going on in the U.S. And now with tariffs, expectations of inflation on the U.S. side, the disruption of all this, financial markets are saying, hey, we prefer to keep interest rates, long-term interest rates high, because we think that there's going to be an impact of what everything's going on in the United States for us here in Canada. So
I think one of the interesting things, right, is, we always talk about timing. Like one of my mentors down in Kleinfelter already said the only difference between the top 5% and the top 25 was timing. They look for opportunities and captured them when the others wouldn't, right? So to spin the tariffs positively, which I think you just got to have a plan for both sides, right? And look for what it could or could not create. Because I agree with you, canola specifically, tariffs aren't a good thing, right? You could say that there's probably a $50 to $60 a ton discount on canola right now. If you use the long-term S&D, right, it should probably be trading at a $700 future, but it has a soybean and a tariff problem. But the low Canadian dollar has also created an opportunity on wheat basis right now for guys to look at. And we were even in a discussion the other day that particularly for a Saskatchewan producer where lots of 28 is manufactured as well as diesel, a tariff could do exactly what you said, could drop the Canadian price for 28.00 in diesel. And it might create a purchasing opportunity. Now, the risky part is in most cases, if you want to hedge risk, when you purchase is when you should lock in a sale on the other side and keep the margin. But I think the 25 crop might be one of those times to not do what we've always done and look for opportunities to get revenue locked in when you think it's good. And then look for opportunities on the purchasing side that the volatility creates. And there might be a path to some pretty good opportunity on the profit side in the end, but it definitely isn't going to be a typical growing year.
I love it, right? So what you're saying is, in some sense, is like it just flips the entire kind of what we've been used to think about in terms of relationships in supply and demand, what you would expect, right? So you have to think different, is basically what you're saying. And I love it, right? Because there'll be opportunities. There will be opportunities if you focus really hard on what you can control, kind of like where do you buy from and kind of what is your financial risk management plan, your marketing plan. I think you'll find those opportunities, but it's going to be quite disruptive. 100%. Absolutely.
And I think we're going to start seeing that gap, like we always talk, the 2, the 18, the 80. We're going to see a gap between the farms that have the acumen and have the marketing and have the ability to actually strategize, like we just said, versus the guys that usually just wait and sell when they need money and buy when they have money. And it's going to create a huge shift of wealth in my eyes.
It's all about being a CEO on the farm, and it's something that Kristjan and I we talked about quite a bit, right? And I know you've mentioned it a number of times in the past, but I strongly believe that the most successful operations are the one that have a CEO mindset. It's not, if you think the CEO at FCC, my boss, she's not necessarily invested in everything that we do at FCC in terms of, being on top of finances, being on top of all these different things, there's different areas of the business, but it's really about making sure that you have the vision, you know the strategy, you know what are the risks to the execution of the strategy, and how do you surround yourself with the folks that really know their job, like really know their role, understand their role, and can actually bring value within your business. I big believer that's gonna be even, it's gonna matter more in the future than in the past. I mean, it's such a critical component of success right now.
What did I say right here?
I threw him a softball.
It was right as we always try to jump on 5 minutes early to just catch up. And I said to him, I haven't decided if I love or hate the fact that my 2025 calendar is just meet with as many smart people as I can. And I'm not really sure if I get to do anything else. Just because, we've always said the same thing as you, right? Is as your operation matures, and if you can have great people, which I'm pretty blessed with, the worst thing I can do is micromanage, right? Because they do a great job, and the more I step back, the better they do. So then it's kind of defining that CEO role for the farm, and you're right, vision, strategy, execution, and the thing I'm finding now actually is probably the number one thing is just having a strong, smart network to bounce your vision and ideas off of and get their vision and ideas. And then magically you kind of start filling whiteboards, right? Like, and it's little pieces and nuggets of information from every conversation that help you kind of turn that ship at critical times that are hopefully correct. And I mean, some of the stuff we've been looking at right now is some of the feedback we get is some of the podcast guests, we stay up at 1 million feet. Well, to take this down to today's level, local canola basis is like $60 to $70 a ton, right? The crush, call it somewhere between 0 and -15. But if you look at new crop, crush basis in Yorkton, Saskatchewan is kind of a 0 to -5, -10. Well, if tariffs come in, like local basis is not getting better. It's getting worse. And crush is the one thing where you can still sell to, but crush fills up. So I think one of the big opportunities right now is to get deliveries locked in at crush for September, October, November, December, January, because canola is crushed locally. And so you know that you can deliver it, get your cash, and you still have a futures market you can trade, although volatile, where some of our other crops, we don't know what the tariffs are going to do. I mean, if you're growing mainly special crops, or if you're a pea, lentil, durum grower, it's really hard to maybe know what your cash flow is going to be. And so what are you preparing on that side? So, I mean, I think it's trying to take those high level, Trump's crazy, you might put a tariff in, and we're not ready for it. But how can that affect, what are you doing day to day to build your plan for that, right?
What do you control? Absolutely, 100%. So I think the question that I was asked the most in the last couple of weeks is that, what should I do? And This is my respond with a question is what do you control? I mean, like within your business, what do you control? And that's really what the focus should be. I mean, at the end of the day, all of these revenue pressures, that's unfortunate because we have to make, like, let's face it, as well as optimistic as I can be, I think we have to make some investments and the entire concept of productivity is such a boardroom type of concept. But if you start to unpack it, right, at the end of the day, it's to be more efficient on the farm. It's to be able to scale up when you can. And I know it's not the right solution for all businesses. And I'm not advocating for large farms or anything like that. I think, it's whatever your size is, you have an opportunity to scale up, and do you have an opportunity to bring different technologies, whether it's equipment, seeds, whatnot. And at the end of the day, that's productivity for me. And the more we can help there at FCC, because it's not just an accountability of the farm or government for that matter, it actually requires all of us, right? So I think FCC, we can bring a number of different things. We can bring different players in the ecosystem. We can bring capital. We can bring a number of different things. And if, at the farm level, I think it's can we educate ourselves to be able to de-risk technology adoption? What are the things that I can do in that front? Government can come in, obviously regulatory approaches and so forth need to be reviewed and adjusted in both, no doubt. So I think it's an accountability of everybody. And if we do that, I still have, despite tariffs and whatnot, I still have a long-term belief that we're going to be really, really successful as an industry.
Well, and we always talk about a controllable versus uncontrollable risks, and it differs for every farm. So for us, weather is not an uncontrollable risk. We have the ability to risk mitigate. We have insurance products. I mean, that is 100% controllable. And we talk about policy being uncontrollable because, yeah, we don't affect the end product or end user. But at the same time, you guys just spent 5 minutes telling me all the ways you're going to control that risk internally. So I think part of it's the mindset that you do have some control and you need to be on strategy this year. No different than Kristjan's going to probably end up doing a lot more hedging this year than we've done in the past few years. And it's a role he's got to come back and fill because, tell you the truth, Jeff and I don't want it.
Well, and I think too, the big thing that farms need to understand is the number one thing they actually control is their own cash.
Yeah.
Right. And we can go through the things, have your 18 months rolling budget, have your scorecards, etc. But the number one thing is just be proactive on cash. So a pretty important thing would be with tariffs. You don't know how concrete your sales plan is going to be if you have one. Well, something pretty simple is and I mean, an FCC could play a role in this, is have you set up a meeting with your banker in February or March and done something as simple as in most industries in the world, the minute you get to kind of 65% loan to value, you can elect to not make principal payments on land in real estate specifically. But have you met with your bank and said, hey, can we get my land loan set up that I can elect to make my principal payments or not because I have enough equity in this, so that if I get to September and I can't get my grain delivered, I don't want to come in and say, hey, I have no money and I got bills due on Friday. No, I held back $500,000 in loan payments in July and August and September so that I'm good till December and will continue to hold back principal till I sell grain, and then I'll elect to pay it off. And I think just being proactive of the things you can control, and you can control cash. And cash and net income are not the same thing. You might grow a phenomenal crop and have all your canola, hedged at $15, and we might see wheat basis and futures go because there was a production scare or Russia-Ukraine fires up even more, that you might have a phenomenal net income. But if you can't access that cash between September and December, you have a problem, right? And we don't see farm bankruptcies. We see farms running out of cash. There's lots of equity there. So how do you have that plan for solvency? And I would argue it's one of the number one meetings you should be doing in February and March. And I would assume JP would agree is to sit down with your banker with your cash flow plan, and FCC and the other banks can help you come up with ideas there.
Absolutely. When you look at the balance sheet of Canadian agriculture, it's super strong, right? I mean, it's to your point, right? It's about cash flow management and sitting down, accountant, banker, and all of those people involved in the financials of your business is going to help. I can't stress that enough. Like, sit down, talk, check in from time to time, and that's going to pay off at the end of the year for sure. Absolutely 100%.
I want to pull you away from the Truth About Ag podcast to highlight one of our sponsors, Farmer Coach, the only entrepreneurial producer coaching program in Canada that offers leadership, finance, and operational training from the dirt to the boardroom. A producer program that focuses on entrepreneurial business practices and growth. An education program that links the professional services world back to the dirt and back to production agriculture. and a mass peer group of all the participants that creates a link and knowledge of both Canadian and U.S. agriculture. For more information, reach out to us at farmercoach.ca. And now back to the podcast. So we're throwing you a lot of finance softball, JP. I want to pull a different direction for a second here. So I looked at your biography before we jumped on here. Why the switch from academia to private?
Oh my God, that's such a good question. Yeah, hey, I can go on. I mean, honestly, so this is a leadership question, actually, Evan. So if, at the end of the day, when I was doing in academia, I was fortunate enough. I graduated from, born and raised in Quebec City. And then, my dad is one of the 12 kids, or the only one of the 12 kids that actually did not end up farming. And so bottom line is graduated in ag economics out of Laval University with a master's, and I was looking to do my PhD. Went to the States in Iowa State. Met some wonderful people there. I mean, it's just 4 really great years. I can't say the best years of my life because I was not married at the time, so I'll refrain from saying this. But bottom line is 4 amazing years. Came back and then got a teaching job, and I was miserable and couldn't understand why. Actually, I had some assumptions as to why. And it was all about other people. It was not about me. Had wonderful colleagues and all that, but you could always find a reason why it was because of the university system and then because of whatever. So I ended up going to the US, took a different job, different teaching job at NC State, North Carolina State. Again, 2 wonderful years. My 3rd kid was born there, so I really don't regret anything. But those 2 years, though, is when I realized that actually, you know what? It's not the university system or the job or the people. It's really about me. Like, what do I want? And at the same time as working a little bit for FCC, and then came up that, I would like to establish a role of chief economist. At the time, like 15 years ago, FCC was perhaps one of the institution at a size where they probably thought we probably need somebody to kind of just steer the conversations around economics and finance. And so, ended up getting the job and came back to Canada. I was really happy, but I thought this job was going to be just a couple of years, and turns out like I'm still in this role and really enjoying it, because at the end of the day, academia is great, and I got some really good friends there, do amazing research, and at the end of the day, the impact you have on people, let's face it, unless you win a Nobel Prize, which I'm not, it's going to be limited. So I think in this role, I think sitting down with customers, overall at different events and so forth, I think we can have a really big impact. And so that's really what I like. And at the end of the day, I want to emphasize that this is the leadership really answer, right? You have to deep down look at what fills your cup. And really for me, as much as I had, a little bit of success in academia, I just wasn't happy. And it was because of me. Like, I had to make myself turn it around. Otherwise, if I was going to wait it was not going to happen. So anyway, I don't regret all of these years. Make some wonderful connections that are still useful to this day. I was at a Canadian Ag Econ Society meetings with lots of people from academia, learn a ton. And, but now I think I really like the role that I'm in, and being able to actually drive success in a lot of different customer operations that we work with. And be a small part of the success. I don't pretend that I'm a big part at all, but just being a small part. So
We talk about that all the time, right? It's no different than people coming up on the farm, right? Just because you have the right last name of the farm doesn't mean you should be the one to run it. Well, maybe you don't want to. Maybe you don't have the skill set to. Maybe you prefer to be the mechanic or the operations manager, and that we're just trying to get farms to look at that. And I mean, another thing we see all the time too is just because the oldest son doesn't mean he should run the farm. I've met some oldest daughters and middle daughters that are phenomenal business minds. And I think it's super important that farms look at that and look at training in leadership, finance, strategy, not just agronomy and new machinery, right?
Well, and I led him on that one, and I love the answer on the leadership side, because I saw a chart today, and it was from the Globe and Mail, and it's on entrepreneurs in Canada, and theoretically let's call it 05 or so, we were at about 900,000, give or take, and we're projected to be next year somewhere in the ranks of 700 or less. So the whole entrepreneur side of business is starting to disappear, And I'd like both your take on that, I guess, from a standpoint of FCC and the business, and then from a standpoint of the farm, Kristjan.
So I can start. I mean, like when you think of ag, this is why it's so humbling working with amazing people in this industry. But if you think of can you think of another industry? I'll put it this way. Can you think of another industry which is as capital intensive as the farm economy, and yet are working with a return on asset as low as it is historically, right? When you look at the entire industry, the return on asset, return on equity has been historically consistently low, despite the fact that we are bringing in as much intensity in terms of capital, right? So I would argue that in the farm sector, the risk reward trade-off has been off a little bit. Why is this? It's hard to argue. It's like, of all these years, just in terms of like, it should be different. It is what it is in terms of just the steady state of where we're trending. But the bottom line is we need to bring in more entrepreneurship, more innovation. Otherwise, I think it's quite clear to me that we're still going to grow. We're still going to be successful. But I mean, the rate at which we're going to be able to add value for the overall Canadian economy and the world, because let's face it, the challenge in front of us in terms of feeding a growing world population and do it in a sustainable way is humongous. So we've got a big challenge in front of us. And if we're not able to change the environment and that businesses operate with or within, then we're going to not be able to grow the productivity that we need to actually make sure that we have success and be successful looking at the challenge that we have in front of us. So bottom line is more innovation, entrepreneurship is absolutely critical to the success of the industry.
Heaps?
I don't really know which way to go with this one. I mean, I think there's three or four things, right? So first of all, and I talk about this is, in agriculture, we do a bunch of things right, but there's a few things we could improve on. And one is, for 20 years here, we didn't do a great job of selling the industry as a good place to be, right? My dad and I talk about it all the time. Dad's, 63, I'm 42. And when we kind of, that's like the drain, right? There's 20 years in there where people were told, don't come back to the farm.
Yep.
Go be accountants and doctors and economists and engineers and everything else, but don't come. And Shout and I see that not only in operators. I mean, don't get me wrong, there's a few diamonds in the rough, people that just did it anyway and have been super successful. But also in academia, in corporate, everything kind of tied to agriculture. There's that void that I think is leading to there not being storytellers to say, come into the industry or come in to be an entrepreneur. And then secondly, because the story wasn't told, I mean, Ev, I'll go back, like when I left M&P, the majority of high-level partners that talked to me told me I was crazy to leave being an accountant to go farm, right? And by the numbers, return on assets, there was a lot of them that were right. But if they wanted to do our financial statements today to just compare, I think I made a pretty good decision.
Just had to put that in there.
Well, a little bit, but it was also risky, right? And I think the third piece is, that we'll go back to stats again. And you're right. When you compare, we don't do a very good job of splitting the real estate business from the operating companies in agriculture. We lump them all into one. And so you get a generation or significant numbers of generations in agriculture that are older. Their goal is to get all the real estate paid off and just pick away at farming. And so the return on assets and return on equity looks low because there's no lever. They just want to kind of keep doing it the way it is, and that's fine. But I mean, if you look at some of the more progressive operations and you were actually to split it and show, here's the land that's been bought from 2000 until 2020 and the return on assets on that number, especially you want to put in, return on equity once they levered it. I'm not sure there was a better spot to have money in real estate in the last 20 years. And then on, the other pieces is the same 20 years, you look on the operating companies, and if they're using any type of leverage, we don't really want the New York Stock Exchange to see the rate of returns. Now, that's also one reason I'm a little nervous going into the next 3 to 5 years is because there's a large number of farms that started in that 2000 to 2020 range that haven't seen real bad times. But hopefully their balance sheet's bulletproof enough to set it up for the success. And then lastly, I would kind of go to that fierce independence, right? I think our fierce independence is what allows us to beat Mother Nature, to get through a tariff problem, and we'll be here in the future. The majority of us doesn't want the farm to ever be sold. But but it also has caused a lack of collaboration, right? A lack of network build. And a lot of entrepreneurs, like, they get their ideas from talking to other entrepreneurs and other people. And in agriculture, there's a little bit of that. I mean, super neighborly when it comes to pulling each other out in the field, or if someone gets hurt. But, to sit down and collaborate on some ideas, or share a CFO, or share a combine, or it's not really our strength. We kind of fall back on fierce independence. So those would be kind of the four levers, I think, that have slowed it down, right?
Okay, so now that we tied into land, JP, am I a buyer? Am I still buying?
Well, the data says that, yeah, you must be buying because somebody's buying. So, no, I mean, like, if you look at the data right now, we're going to be publishing our 2024 overview or year-end type of analysis. March 18, I think, is the date. But the bottom line is the early data that I've seen. We published our mid-year results. We knew that the transactions were down. I think if you look at the last 6 months, all the way up to December 31st, transactions were down as well in terms of year over year type of thing. But I think values are going to go up overall. And looking at 2025, I mean, it's hard to argue that with limited supply, and despite all the challenges of recent years, you still had strong enough demand to drive up land values. So I think people are still buying. Perhaps not as many operations are actually looking to deploy capital right away, maybe a little bit more cautious. But supply is so tight that I think this market is well supported. Now, this is not a statement that to say that, land will never fall, right? I mean, like, at the end of the day, they could. They have in the U.S. U.S. has historically been a little bit more volatile on that front. I mean, in our case, we've only basically recorded gains for more than 20 years. Bottom line is, I think the values are well supported, but let's face it as well, right? In relative terms, land has never been more expensive, ever, right? I mean, analyze it, flip it any way you want, relative to revenues, relative to strength of the balance sheet. Like, no matter how you look at it, land's never been more expensive. It's just that, supply is so tight. I think land valuation is still going up, but don't expect it to go up, at the same pace as before. And I've said this many times, and I've been wrong, actually, because the last couple of years, it has not slowed down as much as I had expected. So who knows, right? But the bottom line is, I do think that it's well supported, because we realize that there are some of the productivity gains, and it's not just the only source of productivity gains that we're staring at, but bottom line is that scale matters a little bit. And so I think demand's still, to some extent, strong enough that given the supply, we're seeing some pretty high valuations coming out still.
Well, and I always love the conversation of 20 years ago, was land overpriced? Yeah. 10 years ago, was it overpriced? Yeah. Is it still overpriced? Yeah.
So I remember, I come from, again, I wasn't raised on a farm, but I come from a farming family, and I remember a lot of conversations about how it is expensive and so forth, right? And so I said in the past, remember, like 10 years ago, 5 years ago, I would say, I've been around so many conversations around how land is so expensive, and I would say it's no different. Now I'd say, hey, those conversations existed in the past, and actually the people that point out that land's really, really expensive, they're kind of right, though. I mean, like, it's really expensive. When you think of, like, in Ontario, for example, and the same thing is, like, the ratios are all different according to the different provinces. But at the end of the day, speaking of Ontario, where you can't even gross the entire, like, just forget about net, but you cannot even gross the payment of land, at current interest rates. So it's really, really expensive in that sense. But bottom line is that supply is so limited that you still see some valuations go up.
Heaps.
Wow, I mean, it's just, I've been saying it's too high for 5 years too. I've been wrong every single year. So I got two stories on this. I have one piece of land that's right between my house and my dad's house. I rented it for quite a few years. I don't know, about 04 time frame. And then it went up for sale, kind of 20,000-ish a quarter over what I thought it was worth. But this was back, we're talking like $60,000 to $70,000 a quarter. And so I didn't buy it. And so every day, twice a day, I get to drive by there and remind myself how wrong I was on 9 quarters. And every time my wife tries to tell me that I think I'm perfect, I say, nope. 365 cons a year, I get reminded twice that I'm really wrong every now and then, right? But I mean, the other one is there's also a quarter on our farm just south of my house Dad bought it in the 80s, and it took from the mid 80s until about 2000 and I don't know 11 to get back to what he paid for it. And from 2011 until today, it's went up 6 times original investment, right? So it's, I think you have to be strategic. At today's prices, you can't be chasing, right? If you have capital to deploy, if you can make the payments, if it makes fields bigger, succession planning, stuff like that, you can have the argument. But the one of the key points is capital to deploy. If you don't have capital to deploy, you need to have a real long look at it, because if it destroys your income statement, it kind of gets a little crazy when it comes to the cash flow we talked earlier on.
I know you guys are hockey fans, and so, when I think of capital to deploy, I'm thinking of a salary cap in the NHL, right? So that's capital to deploy, and there are a number of different ways to deploy it, right? You can trade, you can sign up guys, you can do a number of different things, and that becomes, in today's NHL, such an asset to have just the ability to deploy that salary cap. And I think a capital to deploy it a little bit in the same way. It can be about buying land, that's to your point, Kristjan, or it can be about, bringing in new technology, or it can be deployed in a number of different ways, right? And then there's just not a unique answer in terms of how you deploy it. So
what you're saying is Carolina's focused on having one good quarter and Colorado's focused on having 2 or 3 not bad ones.
It's about the playoffs. And there's one thing, I'm a big Hurricanes fan, he knows this. So really pumped on Friday. I got the trade, heard about the trade. I think we're setting ourselves up to have a nice playoff run. So, and not just win 1 or 2 rounds, but go a little deeper. So that's how I see it.
P.S. Ovechkin got another one the other night, so I'm getting close.
Yeah.
All right. I don't have a lot more, JP. We've been on for 45, so I don't want to keep you too long. But anything else, I guess you wanna get out to the producers while we still got you here?
No, I think the key message going, that if you listen back to what, we've discussed, the three of us, I mean, it's the idea that, there's a lot that we can control, right? Despite the fact that it seems as if, it's highly uncertain and so forth, how you deploy your capital, what the kind of strategy adjustments you make when it comes to financials, when it comes to marketing, when it comes to production. Those are all the things that you control. And so I think that's the key message. Despite all the uncertainty, there's a number of different things that, we do have control over. And I do think that by sitting down with the right folks, kind of doing your homework, dotting the I's, crossing the T's, I do think that we can have a successful 2025.
Anything to add, Kristjan?
No, I think I'd go to the question I kind of like to ask everybody, and it's selfish because I want to know their answer. But it's a 3-part question, JP. So the first one's the long ball. I agree with you. I think there's a ton of opportunity in agriculture. So, where do you think agriculture is headed over the next decade? The big changes. I would say the second part of the question is, what's the FCC doing right now to be on the right track to be there? And then the third part of the question that I always like to ask is, what do we think's not going to change? Because there's always a couple constants. Yeah.
Technology. I think we haven't seen, well, we've seen a lot from a technology standpoint, but we're going to see more. And it's just about, anything from equipment, from seeds, from crop protection. So I think we're looking at the next 10 years being entirely different. I even mentioned AI. We have to be ready. We got to get ourselves ready as an industry on your farm to bring in more technology. Otherwise, we're going to get stuck. The second part of the question is, what are we doing? I think what we can do is bring in more capital solutions, different capital solutions that are going to be able to attract technology, innovation, de-risk adoption of technologies. I think that's one of the things that is critical for FCC to be able to do. And then the third thing is not going to change. And I 100% am glad you asked the question. It's people. This industry is based on people, and it's the best industry out there in terms of who you work with, in terms of who you can lean on. And I think we don't want to lose sight of this, right? People are critical for us to be successful. You can bring all the automation you want, but at the end of the day, it's all about people.
Okay. That was a good one, guys. And I do want to timestamp for JP that it is January 27th, and this might be 2 weeks. So if the tariff changes, all of this means nothing. But Remember to like, share, subscribe, and comment wherever you get your podcasts. And that's the truth about ag.
Thanks for joining us. The Truth About Ag podcast is a proud member of the Heber Group, which includes Heber Grain Ventures, Maverick Ag, and Farmer Coach. We appreciate the support. Lastly, please like, comment, share, subscribe, and ring the bell. And if you have questions for a future podcast, please leave in the comments below. Thanks for listening.